Good morning, everybody. This is Brian Lysing with Financial Brokerage. If you're not familiar with Financial Brokerage, we're a national marketing organization working with life insurance, annuities, and long-term care, primarily independent producers all across the country. And this morning, I'm going to talk a little bit about linked benefit products. They, in general, combine a life insurance or an annuity-based product with some sort of a long-term care benefit. If you had a chance to join us last week for the Linked Benefits webinar, then you heard the basic overview of the different types and styles of products that are available from the life insurance carriers, from the annuity carriers, and why these are so important and why this is a real hot market right now, why consumers like to purchase these. And we'll get into that briefly, but I like to call this the 5 best kept secrets in linked benefits planning. We're going to delve into some more advanced issues. I'm going to assume that you saw last week's webinar. You can find it on our YouTube channel and get the general information about these. We're going to take it one step further and go into some situations that you may not have thought of. You're not going to encounter them every day, but when you do, it's great to have this knowledge at your fingertips and know that you can do some of these advanced concepts when you're in front of your clients. So let's go ahead and get started. I'm going to give, again, a brief overview of the marketplace here. We know that the greatest threat your clients face in retirement, financially anyway, is the high cost of long-term care or extended care. And this morning we're going to go over 5 creative advanced concepts so that your clients no longer have to worry about those high costs of extended care or potentially wasting their premium dollars. You might hear that from a lot of clients. Now, why is this important at all? Well, and these numbers are from a couple years ago, but we know that the annual median rate nationally for skilled nursing in a 24-hour facility is $81,000. It's about half that for an assisted living facility and about half that for home health care. That assumes a 8-hour day, 5-day work week. That's only 40 hours a week. That means somebody else is providing care in the evenings and on the weekends. If you have a client who needs round-the-clock care, it's going to cost them a lot more than the $39,000 a year. Now, at whichever number you pick, your client's money isn't going to last very long. You could look at stock market downturns, and hopefully you've asset allocated them properly so that they don't face a big hit if that happens. But there's really nothing else you can do about this. I mean, 80 grand a year, 40 grand a year, their money's going to go fast. They need some sort of protection. Now, in the past, clients could get that protection through a traditional long-term care policy, and that's still available. Companies are still selling. They haven't gone away. We do a lot of that here at Financial Brokerage. That's still a great fit in a lot of situations. However, there are some problems. Sales are decreasing. Premiums are increasing. Carriers have been exiting the market. This has been going on for 10 or 15 years. It just doesn't get better. We've seen, on the other side, though, that the life and annuity-based LT solutions, those products sales have been increasing like crazy. Now, the latest numbers I have reflect 2013, but we can see back in 06, these linked benefit products made up less than $500 million of gross premiums. And by 2013, they comprised $2.6 billion of premium. Now, what that tells me is people are buying this stuff. If they're not buying it from you, I guarantee you, with these numbers, they're buying it from somebody else. You want to make sure that they go to you, that they view you as the expert in this area. Now, why are people gravitating towards these products? It always boils down to 2 very important guarantees. One is the fact that their premium will never change. If it's an annuity, we don't have to worry about that. If it's a life product, it's a whole life, or it's a no lapse guarantee universal life. They don't have to face a rate increase. The company can't do it as long as they pay their premiums every time on time. The other important guarantee is that a benefit is going to be paid out. This counters one of the biggest objections people give to traditional long-term care. They look at the premiums and then they think to themselves, wow, I may pay all this money and I'll never use this. I'll die in a car crash, I'll die in my sleep, I'll go quickly, what have you. Well, we know that that's not reality. And you can use all the statistics and the logic in the world, but people don't purchase based on logic usually. They make emotional purchases, and they choose to not make purchases emotionally as well. So, hey, if we can't beat them, let's join them. Let's counter that and help them make sure that a benefit's going to be paid out. If they don't use the LTC benefit, their family's going to get the death benefit. Their money hasn't been wasted. It makes them feel better, and now they're covered. And that's really the important part. So the advanced concepts that we're going to review this morning, just to give you a quick preview, there's only 5 of them. We're going to talk about a way to help potentially with an uninsurable spouse. That usually kills both sales if one person gets declined. We're going to talk about a way to put 2 people on one policy. We'll discuss ways to include inflation protection on multi-pay policies, and we'll go over why that's important and why it's kind of hard to do. We'll discuss how you can use qualified funds, maybe from a 401k or an IRA, to pay for this. You usually can't do that to pay for a life insurance policy. I'll show you how. And then the 5th concept is a little more complicated than the others. I call it extreme leverage. We're actually going to combine an annuity with a life-based LTC plan to give the clients more leverage than you've ever seen before. So we'll get started here with the uninsurable spouse. If you've been selling long-term care or even life insurance a lot of times for any length of time, you've probably heard this. You submit the husband and the wife for coverage. One of them gets approved. The other one is declined. You go back and think, okay, well, I can place one policy out of the 2. Yeah, that doesn't happen. What they usually tell you is, look, if they won't take my spouse, I don't want a policy either. We're just going to make our financial situation even worse than it already is. Again, you can't use logic with these people. They don't buy based on logic. So here's a potential solution. This won't work for everybody, but now you have something to come back to them with. Now, we're still not going to get coverage on that uninsurable person. Let me make that clear. But we can make sure that the insurable person has enough extra coverage and craft it in a way that they're going to have extra money they can use for their uninsurable spouse's care if needed. So here's what we do. We use AIG's Secure Lifetime GUL. It's a universal life with a no-lapse guarantee. We write this on the insurable spouse, and we put on 2 very important riders. One is their accelerated access rider. It's their chronic illness rider. So if your client loses 2 of 6 ADLs or has severe cognitive impairment and the condition is deemed to be permanent, then they can receive this benefit. Now, back in 2014, it was only $9,900 a month. That has been increased to just over $10,000 a month right now in 2016. This pays out as an indemnity benefit, meaning the money can be used for anything. You don't have to prove that you've had expenses in that amount. It's your money. If you want the whole $10,000, you can take the $10,000. Maybe your expenses were only $5,000 that month. That's fine. Now you have an extra $5,000 to help pay for your spouse's care if they need it, or put it in the bank. They have another rider you'd want to put on here. They call it the Lifestyle Income Solution Rider. And this is really interesting. I think AIG is the only one that has this. It states that when your client turns age 85, they can elect to take 10% of their death benefit per year. They can accelerate that for any reason. They don't have to have a qualifying health event at all. They just have to be 85 and say, I want my money. They can actually take the money earlier than age 85, provided certain conditions are met, but AIG is going to keep part of that, so they don't get the full 10% at that point in time. So here's an example to give you some actual numbers to look at. Husband and wife, and we're going to assume here that the husband was uninsurable. He didn't, his lifestyle wasn't quite as good as his wife's. So we're going to write an application on his wife, who's 60 years old. She's a preferred non-smoker. $500,000. It's going to cost her about $10,000 a year. Now, we're going to put on the per diem chronic illness rider. That means that whatever the federal per diem limit is for LTC benefits in that given year, that's what AIG will pay out to her for chronic illness. So up to $10,200 a month. She just has to qualify and say she wants it. She can also have, in this case, 10% of her face amount is $50,000 a year. That's available for any reason beginning at age 85. Now, how can we pay for the husband's expenses? Well, one, when his wife, who is still healthy, turns age 85, and let's assume she hasn't needed any care up to this point, she can turn on that LIS rider and receive $50,000 a year. Now, that might not be enough to cover her husband's LTC expenses, but it's $50,000 a year that they didn't have otherwise. Additionally, if the female in question here qualifies to receive benefits under that chronic illness rider, she's going to receive $10,200 a month. That's over $124,000 a year. If she has money left over after paying for her care, they don't care where the money goes to, so they can use that for his expenses as well. Again, it's not perfect, but it does give you some way to go back in and potentially make a sale that covers both spouses if one of them ends up being uninsurable. All right, let's go into the second advanced concept here. We'll talk about joint coverage since we're talking about a husband and wife situation here. Now, this is something that's fairly common with traditional LTC policies, or at least was years ago. It consists of a shared pool of money that both husband and wife can dip into if they have a long-term care event. Now, this is not available with most life insurance-based plans out there. If you want to insure both of them, each person has to have a policy. Now, with State Life and their asset care product, this is the one carrier that does this. Both spouses have access to the policy for LTC expenses, and the death benefit, if there's anything remaining, will pay out at the death of the second insured. So here's how this compares to purchasing two separate policies. And since we're looking at State Life and their asset care product, I decided to use that as the individual policies we're comparing to. So in this case, we have Howard and Marion. They're both 60. They have a $250,000 death benefit, which gives them $5,000 a month for LTC purposes. And we have the premiums below. Together, that comes to just over $17,000 a year. That's the traditional way of looking at this. They each have their own policy. Now, here's the problem with that, though. What if Howard, for example, develops Alzheimer's at age 75? He needs care for the next 8 years while his wife remains healthy. Well, if we look back on this page here, $5,000 a month, divide that into $250,000, Howard has just over 4 years of coverage. He has Alzheimer's for 8 years. He's going to blow through his policy in 4 years, and then they're paying out of pocket for the next 4 years. Meanwhile, Marion has this pool of $250,000. She's healthy. She hasn't touched it. Howard can't touch it because it's Marion's policy. Well, here's a better way that can solve this problem. So what if, instead of two separate policies, Howard and Marion purchase one policy, a joint policy, for $500,000? We have the same death benefit in total. Their monthly LTC benefit is now $10,000. So if they each needed $5,000 a month at the same time, hey, we haven't lost anything here. But look at the premium savings. We're saving them over $3,000 a year by crafting a joint policy. And on top of that, we have flexibility. If we have that situation I explained, and Howard needs 8 years of care and Marion never does, they haven't wasted any money on the other policy. Howard can use the entire $500,000 if he's the only one who needs care. So that's the couple situation and the joint policies. I'm now going to go into a unique way to deal with inflation protection. This is something that is very, very common on traditional LTC policies, and in a lot of illustrations it's required. I remember clients having to sign off saying that they didn't want this in some cases. But it's very common to see a 3% or a 5% simple or compound inflation option added to a traditional LTC policy. And some of the single pay linked benefit plans have these riders available. State Life, the MoneyGuard product, the TLC with Genworth. Where we run into problems are with the more popular plans, the multi-pay policies on a UL chassis. They just don't offer inflation protection for the most part. So what can we do? Well, we've got to get creative here. And there are two ways to do this. And again, it's not perfect, but there is something we can do. So first off, AIG and Mutual of Omaha. We talked about that federal per diem amount. So rather than having your traditional 2% of the face amount per month, you can choose with those companies to have them pay out up to the per diem amount, which is $340 a day this year. This typically increases with inflation at a rate of about 4% per year. This is a way to give your client a greater monthly amount built into their policy. Now, their total pool of money is going to remain static with this. It's not going to increase the full amount they have, just the amount that they can access every month. So that's one way to sort of build in some inflation protection. The other way is to utilize one of the carriers listed here, AXA, Met, Prudential, Transamerica. they all offer an increasing death benefit option along with their chronic illness or LTC riders. Now, you might start out with, say, a benefit of 2% per month, and if that's based on a $100,000 policy, it's $2,000 a month. Well, as your $100,000 grows, the 2% figure is going to grow as well. So this is one way to have both an increasing pool of money and an increasing monthly benefit amount. The only downside to this is, a lot of these products here, these carriers, do not offer a no-lapse guarantee on that particular product. So it's tough to get the combination exactly right. You can get that with Prudential, though. If a client wants to guarantee, they want to increase both their total pool and the monthly amount available. So again, we've got to get creative here. Now here's an example of how that might work. I took a look at AIG, but Mutual of Omaha would work the same way. And I based the inflation numbers on 2014's per diem amount. And we can see we're not too far off here. In 2016, the per diem amount would be $10,200. And as it projects on up at 4% per year, we can see by 2030 we're at 18 grand. By 2040 we're at $27,000. So that's one way to build in inflation protection. The other way is by, again, using an increasing death benefit. I know those numbers might be kind of hard to read, but we started out with a pool of $250,000. And by the time our 50-year-old client turns 75, we've now got over $500,000 projected. So we've about doubled their coverage in a 25-year time span. And of course, that keeps going up and up. We hit $1 million by age 90. That's 4 times the original amount. So if they're willing to forego the no-lapse guarantee, they can certainly have that increasing death benefit option there. All right, I think we're on to our 4th advanced concept here. We're going to talk about a way to fund one of these products with qualified money. Now, usually with life insurance, we can't use pre-tax dollars to purchase a life insurance policy. There are some business situations where you can. But I'm going to throw a what if at you here. What if you have a client that wants some extended care protection, doesn't have the cash flow for the recurring premiums, the monthly premiums? They just don't have it. They don't have a lump sum for a single pay product either. The vast majority of their assets are in a qualified retirement plan. I would tend to think this is like a lot of Americans right now. They don't have the big lump sum sitting around. Money is tight, yet they've got a big 401k sitting out there or some sort of a retirement plan. Well, normally we can't touch this. Well, State Life has found a way to move that money around. And incidentally, you can do this with North American as well and have it all handled by the same carrier. But here's sort of a flow chart of how this works. And I'm going to talk about State Life in the example here. We've got the money in the 401k or the IRA. We're going to conduct a direct transfer into one of State Life's annuities, their Asset Care 3. Now, there's no taxes at this point in time. We're just moving the money from one qualified pocket to another qualified pocket. What State Life will then do is over 20 years, they're going to pull out roughly 1/20th of the money from that annuity and put it into their Asset Care 3, the life insurance product with the LTC rider. Now, every year the client's going to get a 1099 for that 1/20th of that lump sum that moved over. But that's a lot better than having to pay the taxes on that big sum all at once. So it makes it bearable from the client's side. Here's an example I ran. We've got a male, age 60, and all we did was move $200,000 out of his 401k. And the way the numbers work out, we've got about 13 grand that comes out of the annuity every year to pay the 20-pay life premium. Of course, he has to pay taxes on 13 grand each year for 20 years. It's a lot better than paying taxes on $200,000 in one given year. Here's the illustration, the way that lays out. If you need to see an example. All right, I'll pause for just a second. All right, this is our 5th idea here, and bear with me because we're going to combine an annuity with a life-based LTC product to give your client just a tremendous amount of leverage. I think this is a real innovative idea. I got the idea from Lincoln Financial, from one of their sales emails a while ago. And at the time, I was using one of their income annuities to run this. I have since found out that another one of our carriers here at Financial Brokerage can do a little better with their annuities. So the numbers are going to look a little different than they may have in the past if you've seen this webinar before. So here's our traditional situation. This is what we're going to compare against. With a single pay linked benefit product, we have the single premium. And what I was comparing against, I don't have the numbers here, but it was a $200,000 payment. And that purchases a death benefit for the client and a long-term care benefit. You'll see in a chart how much that long-term care benefit ended up being. But that's our baseline. What if the client has $200,000 to work with here? And how can we give them even more leverage on that money? Well, here's how our flow chart changes. Instead of just buying the linked benefit product, we're going to use that single premium. We're going to purchase an annuity with an income rider. So we can start taking an income off of this annuity right away. And for the first 10 years, we're going to put this into the MoneyGuard product, their 10-pay product. And in 10 years, it's going to be paid up. Now, so for those first 10 years, we're not able to use that income money for anything else. However, starting in year 11, that money keeps coming to the client. They no longer have to pay the 10-pay premiums. And incidentally, that money doubles if our client needs LTC in some fashion. So here's how the numbers work out. Now here's the illustration. Yeah, I'll get to the numbers here. Let's see. Yeah, I'm going to go back here. All right, so originally, and we'll get to the chart, it's a little easier to read, but here's all the details behind it. Originally, we had $200,000. Turns out that with this American Equity Bonus Gold, we don't need the whole $200,000 to fund this. We need only $176 and some odd change. So what we're going to do is at age 60, this is going to generate $9,360 a year beginning in year 2. Our client has to pay the premium out of their pocket in year 1. But that's okay because we were comparing to $200,000. 176 plus 9,360 still is less than 200K. So what's going to happen here is that 9,360 is going to fund that MoneyGuard 10-pay, and that's going to give our client $320,000 of tax-free LTC benefit. And I put on the 3% increase on that as well, so we could have an increasing benefit. After that 10-pay product is done being funded, our client, like I mentioned before, continues to receive the annual lifetime payment of $9,360. And if they require long-term care, this annuity income doubles to just over 18 grand. Now here's our total numbers by age 80. We're going to just guess that's when our client's going to go on claim. Well, they've had $187,000 total income generated by our annuity. Now, keep in mind, we only put in about $176,000, and we've generated $187K off of that. We've used that to purchase over $500,000 of LTC benefit at this point in time. And of course, we do still have a minimum death benefit there. Here's a chart that I think probably makes this a little clearer. We have our single pay example on the left. What if we put $200K into a MoneyGuard? Here's our monthly LTC benefit amount. What if instead we use the extreme leverage combined in income annuity with the 10-pay MoneyGuard? Year 1 is the only year where this doesn't look good. Now let's hope that your client doesn't go on claim for LTC within the first year of taking out the policy. Now it is a little bit of a risk, and it could happen, but I think in most cases you don't have to worry about that. So here's what happens in year 2. We're assuming that the MoneyGuard is paying out, and we also have our annuity paying out to us to some degree. Now, that annuity payment has got to go to pay for the MoneyGuard still. But if we need LTC services, that payment has been doubled. So now we have extra money that we can use for LTC. Now, you're going to see a huge jump in year 11 because now we don't need the $9,360 to go into the MoneyGuard. It's paid up at this point in time. We get that whole $18,000 plus whatever benefit we're getting from the MoneyGuard product. by year 20, the 25,000 figure, that's our MoneyGuard payment plus the annuity payment. And actually, I think it's just the MoneyGuard payment. But if we've been pocketing our money for the last 10 years, remember, we don't need it to pay the premiums anymore. Well, if we didn't get any interest on our money at all, we'd have almost 100 grand. If we didn't go on claim until year 30, our payout's just over $28,000. Plus, if all we did was pocket that $9,300 a year, we'd have nearly $200,000 as an extra pool of money to draw from. And even at year 40, if our client lives that long, well, finally the single pay product comes out ahead just barely, but we don't have that extra $280,000 there to help out either. So again, it gets a little more complicated. I wouldn't use this for every client out there. Maybe your more sophisticated clients who understand how to leverage their dollars like this. Again, this involves combining an income annuity with a 10-pay MoneyGuard. So to recap what we went over this morning, we discussed a way to get coverage potentially for an uninsurable spouse, or at least provide funds. They're not going to have a policy, but we can have funds available for them. We discussed a way to get 2 clients on one policy so that they don't run out of benefits potentially. Discussed ways to put some form of inflation protection on the multi-pay policies, and that's important. According to LIMRA, about 75% of the linked benefit plans sold are recurring premium payment policies. It's only a quarter of them that are of the single pay variety. We discussed a way to fund one of the single pay products using qualified money, which I think is going to be the case for a lot of Americans, is maybe the only funds, the only resources available. And we also went over a way to combine products to give our clients what I call extreme leverage. So your mission, should you choose to accept it here, is to realize that you can protect your clients' assets from the greatest threats, the greatest financial threats they face in retirement by presenting some creative advanced solutions with linked benefits plans so they no longer have to worry about the high cost of extended care or wasting their premium dollars. Now, I'll check here for questions. If there are any folks out there that you know of, any other producers you work with that you think would really benefit from this information, by all means, don't keep this a secret. Let them know about this, about me, about financial brokerage. I'd be happy to talk to them, and you might even be eligible for the new referral bonus that we're offering. So let me get to the questions here.